So I went back into our corporate libraries and pulled out an earlier version of our HMA. This is from 1983. It's the first page of a 4-page HMA at the time. It was for Procter & Gamble, and Arnold at this point was looking at the low prices of the stock and getting his buy point. And the thing you'll notice that stands out is it was all handwritten. And knowing Arnold, if you know him, you know his handwriting hasn't changed a bit since then. So he's a very consistent man. But what we also see is this is before the digital world. And the reason it was handwritten is because we couldn't download the information. So we had to dig through annual reports to pull it out. We didn't have the automatic downloads that you have. And, you know, Al Gore was still in his basement creating the internet, so we didn't have that benefit either. But we had to go through annual reports, 10Ks, 10Qs, and extract years of data, and then boil it down to the pertinent information, and then put it into the template. So as you can see, before the digital world, much of what we did was kind of offline as opposed to online. This is the new HMA. This is the 2012 version. Now, I know you can't read it, and I don't expect you to be able to, and don't worry, we're not going to go line by line on this. But I wanted to show you what it looks like just to give you a sense of what it is that we do. So Arnold's Baby has now grown up to be a multi-tab Excel workbook where a complete analysis with an HMA, a 5-year forecast, and a segment analysis prints to about 20 pages. We break down our HMA into 4 sections. The first part is the income statement. The second part is the balance sheet and leverage ratios. The next part is our historical prices where we compare it against valuation metrics. And then finally, we put it all together and put it into numbers where we have our buy point, sell point, and we call that our valuation structure. So let's look at the income statement and what we look at when we look at the income statement. This is a 20-year look. So we're looking back over 20 years of the income statement and the financials of a company. And we do this for a lot of reasons. But in doing it, we're assessing the sales, the margins, the growth rates over the past 20 years. We're looking at the cyclicality of the business, how profitable the business is, how much cash it generates. And then we look at each segment and how each segment impacts the whole. In essence, what we're trying to accomplish by looking at this is we want to see how the business operates during recessionary periods, and there's a lot of them during the last 20 years, what happens to sales and margins, what happens to the growth rate, what happens to the profitability in those down years. And then we also want to see how the business has changed, how has it evolved? Because it's how the business has operated in the past, how it is now, that helps us project what's going to happen over the next 5 years and create our best case scenario or the most appropriate scenario based on today's environment and what we see and how the company is structured. In the next section, we look at the balance sheet. Balance sheets are very important. We want strong balance sheets, so we're looking historically, again, over a 20-year period, at the changes in the capital structure, the debt levels and the debt ratios. We want to study what acquisitions have played on the business, how the debt has occurred. Has it come from acquisitions or from share repurchases? We look at hidden assets and hidden liabilities. And again, all from with the idea of looking at how the business has cycled through economic downturns, where it is today, and what we can expect going forward in the future. So up until this point, we've been analyzing, kind of how the business works, what makes it tick, and how does it operate during recessions, recoveries, and peaks. This next part of the HMA is where we look at how the market prices the stock relative to its valuation metrics in those downturns and in the peaks. We've got 14 different valuation metrics that we apply, and we're looking at how it's priced relative to those metrics during all the down years and all the up years. And there's patterns that occur. There's patterns that occur in industries. There's patterns that reoccur in individual businesses as well as the markets. There's some companies, for example, that are very steady and they grow at a pretty even keel. And so all the 14 metrics that we look at are relevant and they're consistent, both at the top and the bottom. But there's other, more cyclical companies where 14 metrics aren't really relevant, and maybe it's 1 or 2 that are the most relevant. I'll give you an example of that in a couple of slides. And then finally, we take everything we've learned about the company, about the industry, from a valuation standpoint, how the business has changed, and we quantify all that in what we call our valuation structure, which is where we have our worst case, our buy point, and a sell point. So again, the worst case, we're assuming a recession. Don't know when it's going to happen, aren't predicting it's going to happen today or tomorrow, but sometime in the future we know we're going to have a recession, so we assume that. We look at the fundamentals that we would expect in a recession. Arnold talked about that with Cisco. We apply recessionary multiples to those fundamentals, and that becomes our worst case. Our sell point, we're looking at recovery level fundamentals and applying recovery level multiples. But in order to get the buy point, we require a margin of safety. And the way we look at a margin of safety is through our reward to risk ratio. So Arnold mentioned this earlier, 3.5 to 1 is what we want for big cap stocks, and 5 to 1 is what we want for small cap stocks. What that means is we want 5 units of upside for every 1 unit of downside. So for example, if we have a stock that has a sell point of 20 and a worst case of 8, in order to get 5 units up and 1 unit down, we can pay no more than $10 for that stock. At $10, it gives us 2 points down, 10 points up, 5 to 1. That's our required rate of return, or required margin of safety, if you will. And so that's how we arrive at that. We take all of that. We do this for every stock and put them all into a database, a spreadsheet that we call our dashboard. And then we sort that dashboard by the reward to risk ratio. So we want the highest reward to risk ratio we can get. That means the stocks are the cheapest and we've got the odds in our favor. That's how we manage the portfolio from an individual stock and from a portfolio standpoint. So those with the highest reward to risk we buy, those with the lowest we sell. And this is what we're looking at every day in our portfolio management meetings, analyzing the businesses, looking at the buy points and sell points, and then building and constructing portfolios along the way with that. And it also dictates the weightings of each individual stock in the portfolio.